One question confuses many business owners. My LLC has two owners now. How do we pay ourselves? Do we put ourselves on payroll? The answer surprises many business owners. In most cases, the answer is no. I'm an enrolled agent with over 14 years of experience helping business owners navigate taxes, accounting, and IRS rules. Let's talk about why. In our last video, we learned how the owner of a single member LLC generally pays themselves. Today, we are adding another owner. Imagine Jane and Jennifer. They decide to start a home care agency. They form an LLC. They are both owners. The business begins to grow. Clients start paying for their services. Money starts coming into the business. Now, they have the same question many business partners ask. How do we get paid? Here's the first thing to understand. Even though both partners work in the business every day, they're still owners. Adding another owner does not turn the owners into employees. Partners are generally owners, not employees. That means they generally do not put themselves on payroll simply because they work in the business. So if partners generally don't pay themselves through payroll, how do they receive money? They generally receive partnership distributions. A partnership distribution is simply money the business distributes to its partners. Let's make this practical. Jane and Jennifer deposit all client payments into their business checking account. Every business expense is paid from that account. Caregiver payroll, office rent, insurance, software, supplies, utilities, everything flows through the business account. The business money stays inside the business until the partners decide it's time to take money out. Then each partner transfers their distribution from the business checking account into their own personal bank account. Most banks make this easy through online banking. It's simply a transfer from one account to another. Some partnerships make distributions every month. Others choose quarterly distributions. Some only make distributions when the business has enough cash available. The timing and amount should follow the partnership agreement. Now, here's something that's very important. A partnership distribution is not necessarily the same thing as profit. Let's say the business earned $20,000 this month. That does not automatically mean the partners should split $20,000. The business still has obligations. Maybe payroll is due next week. Maybe insurance is due. Maybe estimated tax payments are coming. Maybe the business needs to purchase new equipment. Or maybe the owners want to keep cash inside the business for future growth. Good business owners don't just ask, how much did we make? They also ask, how much does the business need to keep? That's one of the best financial habits you can develop. Many new partners think they should split every dollar that comes into the business. That's one of the fastest ways to create cash flow problems. Remember, the business has to pay its bills before it pays its owners. Healthy businesses protect their cash flow. Then they make owner distributions. Now, you may also hear another term, guaranteed payments. Guaranteed payments are different from partnership distributions. According to IRS publication 541, they are payments made to a partner without regard to the partnership's income. Here's a simple example. Jane works full-time, managing caregivers, meeting with clients, and running the business. Jennifer also owns the business but has another full-time job and spends less time working in the company. The partners may agree that Jane should receive a fixed payment for the work she performs, regardless of whether the business had a profitable month. That's one example of where guaranteed payments may come into play. For today, I simply want you to know they exist. We'll talk more about them in a future video. Before we finish, here is one professional tip. If you're starting a partnership, don't rely only on verbal agreements. Work with an attorney to create a written partnership agreement or LLC operating agreement. The IRS recognizes that partnership agreements may be oral or written. However, if the agreement doesn't address an issue, state law generally fills the gap. A written agreement helps everyone understand ownership, profit sharing, partner responsibilities, distributions, decision making, and what happens if someone leaves the business. It also makes tax reporting much clearer and helps prevent misunderstandings before they become expensive problems. If you remember just one thing from today's video, remember this. Partners are generally owners. Owners are not generally employees. That's why partners generally pay themselves through partnership distributions, not payroll. In our next video, we're going to talk about S corporations. You'll learn why S corporation owners often do pay themselves through payroll and why the IRS treats them differently. See you in the next video.